Good afternoon, everybody. Before we get into the discussion, let me set the context of what we are going to discuss. If you're familiar with the statistics, in 2017, the money which was raised in the US in public markets was actually significantly lower than that was raised in the private markets. And likewise in ASEAN. If you look at the number of listed companies which existed last year in the US, they were actually bigger and larger, but in terms of the number of companies, public companies, they were actually lower than the number of public companies which existed in 1996. Now, these are amazing stats. Conceptually, we were till very recently in the midst of what is arguably the longest stock market boom. But the private markets was actually raising more money and being more active than the public markets. So we put together a panel of very eminent people here representing arguably both sides of the spectrum. And it'll be our intention to discuss a few issues relating to both public and private markets and get a different perspective from all of them. So that's the context and the background to this conversation. Matthew, let me start with a question for you. What, in your opinion, would the key differences between private and public exchanges be? Very briefly for the audience.
Sure. I think in terms of the key differences, it boils down to 4 key differences between the private exchange and a public exchange. The first and foremost is the regulatory oversight and disclosures for the purpose of IPO or post-IPO, ongoing corporate disclosures. So number 1 is regulatory. Number 2 is the investor targeting. That means the investor pool that each exchange will offer. So the private exchange will be more limited, whereas the public exchange, you have a global and deeper pool of investors that can invest into your company. The third one is the valuation methodologies. With regards to the public markets, I think it's pretty standard. Either we look at the comparables, we look at the cash flow, we look at the price to earnings multiple. And also the public markets is very affected by macro volatility and also in terms of post-trading liquidity. If we go to the private markets, then the valuation there is, it can involve revenues, it can involve also the earnings, but then we also look at product development and also business plans. And lastly, I think it's a transaction cost between the 2 exchanges, the private and public. Clearly, the transaction cost in terms of advisors' costs, in terms of listing costs, will be more for a public exchange compared to a private exchange.
Thanks, Matthew. Greg, Matthew has obviously put forward a few arguments supporting public exchanges. Would you want to respond to that and talk a little bit about the regulatory aspect, which Matthew mentioned, and how it works in private exchanges?
Sure. Yeah. I think what we're seeing in the market is sort of bifurcation of investment style and increasingly of investors. And so I think, as Matthew said, the sorts of things that investors look at when valuing private companies versus public companies is different. And I think that difference is deepening. And by that, what I mean is it seems, at least to me, as though the public markets are becoming increasingly short-term focused. They're more and more dominated by high-frequency trading that is focused on quarterly earnings. And in the private markets, obviously, it's just, again, as Matthew said, right, there's focus on business plans and product, which I think is, or maybe another way of saying that is on a longer-term value proposition or on the vision of the company. And so I think just as investors are starting to self-select, where those that whose strategy involves identifying companies that over the next year, 2 years, 5 years will do something great. And in the public markets, people are looking to arbitrage very small, pennies on forecast earnings versus actual earnings. I think entrepreneurs and private companies are saying, if I'm in a stage of hypergrowth where I'm growing 50, 70% a year or more, I'm not in a good position to tell people to the penny what my next quarter's earnings are going to be. And so given the reaction public markets have to companies that miss their earnings, that starts to look quite hostile as compared to the more, say, the venture capitalist mentality, which says, again, I'm focused on the longer term view. So what we're seeing in our market is increasing influx of institutional and other capital who are focused on the long term. And I think both of those types of marketplaces have a critical role. It's just the divide between them is now deepening.
Thanks. Kaidi, do you want to talk a little bit about the trust and credibility? Because very often there is a perception, right or wrong, that public markets are generally associated with more trust and credibility. Would you agree with that?
Yes, I'm happy to jump in and actually sort of argue with Matthew on some of the aspects. When we talk about the trust and credibility on the stock markets and exchanges, it doesn't matter if it's the private or the public, the trust consists of two sides. One is the issuer side. Can we trust the issuer? And it's very much about the attitude of the companies. It's the attitude of the founders and the CEOs of the companies, and how do they treat the investors, and what is their attitude towards the posting the information and sharing the information and actually treating the market. But the second aspect is the market operator and the trust built in the market operator. And this is what Craig said, is actually that the main markets transforms into the platforms of high frequency traders. So the main aim of the marketplaces should be companies wanting funds to grow the companies, and then investors invest. When you invest for the main markets, then who actually gets the benefit? Is it the investor? Is it the broker? Is it somebody behind the machines? Is it the algorithm? Who is it? So that's why I see that the private markets also and the new race of the new marketplaces, they tackle the essence of the marketplaces, being there for issuers needing the money and investors investing and eliminating some of the intermediaries in between. So it's the operator. Can we trust the operator? Can we actually trust all those intermediaries behind the operator, and then the issuer?
Just or add a thought to that. It's also, I think sometimes people confuse a trusted marketplace with a marketplace where every company succeeds, right? Even in the most successful or most successful public companies, obviously, or public marketplaces, many companies don't succeed, but the rate is going to be, of course, much higher, the rate of failure, that is, much higher in earlier stage companies. So higher risk, typically there's going to be higher reward, but I don't look at that necessarily as a shortcoming of markets that support earlier stage companies. That's just the nature of the companies that they support.
No, we'll come back to this issue later on as to whether both private and public exchanges have a role to play in the evolution of the life cycle of a company, but we'll come back to that later. Rebecca, just to get you in on what Kaidi and Greg have mentioned about the trust and credibility, would love to hear your thoughts, and with specific reference to the KYC and the due diligence aspects, because very often it's said that the extent of KYC and due diligence is a lot more rigorous for public exchanges, and that enhances the credibility and trust.
Yes, and I also think that the points made are, some of the points made are fine, but I think some of the points are greatly simplifying the public market. So there are many different types of investor in the public markets, and some of those include long-term shareholders. But it really is, the company does need to be in a position where they can accurately predict revenue. They need to stand up to scrutiny, the type of scrutiny that they would get from US public investors, which is quite strong. So the company needs to be able to handle that responsibility. And then also the company needs to be delivering on the vision. So quarter after quarter, delivering on the promises that the company is making to the market. And those types of things need to be quite clear in the beginning. Otherwise, you can go public, but it's not going to work out too well. So the company does need to be in a certain time, you know, in its evolution. Also, it adds credibility to the company to be listed, and especially in the US, where the corporate governance regime is well respected. So the US remains the deepest capital market in the world, and it's the most active and the most liquid. And part of that is the pure disclosure regime in the US, where the company needs to be disclosing all the relevant information for the company, for the investor to make the right choice. And it's an ongoing, serious undertaking that the company needs to comply with. So absolutely, for a company that is wanting to meet those higher standards, then a public listing can work out well. And also it signifies that the company is a permanent fixture in the economy. So you are saying that you are here to stay, and you are saying that you can deliver on the company's mission, and then meet all the requirements that are necessary to do that.
Thanks. Now, we've talked a little bit about the differences between public and private exchanges, specific attributes and factors. Maybe a good time to talk about the commercial viability of private exchanges. I'm sure all of you will have a view. So Greg, you want to start with this?
Sure. So certainly I am a little biased as an operator of a private exchange.
I'm extremely surprised by that.
Yeah, I know. I'm going to go out on a limb. But yeah, no, I think, you know, in 2009 when we started SharePost, it was really, you know, maybe unclear, and it was sort of a hunch, or, you know, a bet that maybe some things that were thought of as being just kind of cyclical downturns were actually much more structural. But I think, and we're leading companies to stay private longer, but I think at this point it seems fairly clear, and you can see it in a number of different ways. So one, just the number of companies that would have otherwise, or in prior eras, have been public, are choosing to remain public. So it all started with Facebook as the original unicorn. That's why we called it. It's sort of forgotten now, I think. But we called Facebook a unicorn because there was just one of them. But now fast forward, say 7 or 8 years, and they're now, I think, coming up on $300 billion plus market cap private companies with an aggregate market cap of over $1 trillion. And it started in the US, but it is now a global phenomenon. I think another way that you can look at it is just what are the trends that are driving this. So as more and more capital seeking growth equity returns can't find it in the public markets because the private companies are staying private longer, they're migrating into the private market, which only deepens the private market, which in turn makes it easier to stay private longer. And then it just actually, the last thing I say is you look at the amount of capital that's been raised, some of the stats that you provided, but there, I think it was $220 billion has been raised over the last 3 years, dedicated to this asset class. So in terms of its longer term prospects, I'm quite biased, but it really does seem like this is a trend that is only going to accelerate and continue.
Kaidi?
Obviously, I support being now sitting on the private market side and working for the public before. The first is the price of the capital actually you can get. I'm a company and raising funds myself. So I see the price of the capital that is now placed by the private capital, whereas company going public. And there's so many regulations around the private markets. At one point, it's good. But on the other hand, for the companies going the funds, it's setting the price tag so high for the capital that you don't see its option anymore. You see more like a exit option for the maybe early stage investors. And when you're running a private exchange or a private capital, and especially when you can start building it from the scratch, then first you need to tackle the global market because the businesses are global, investors are global, and you should be able to invest and trade whenever you want and wherever you want. So you don't need a local broker for example. So these are these changes. We see why private exchanges take the sweet spot of the early stage companies, of the growth companies, and let's see what's and how the regulators and how the technology actually can make the main markets or the public markets come closer to the private markets, and how long companies tend to stay in the private market.
Thanks, Kaidi. Matthew, Greg, and Kaidi have articulated a few points.
I should sit like this.
No, I think.
So I'm sure you'll have a few thoughts.
I think both the private.
Actually, what we should have done, and if I had known it earlier, I would have ensured that you mixed up the seating arrangements a little bit.
Yeah, is now a good time to mention that Nasdaq has a private market as well?
I was going to come to that at some point.
I think both private and public exchanges are actually complementary to each other. If you look at the private market, private exchanges at the moment, it's actually very fragmented in terms of the number of exchanges, in terms of the investors, in terms of the types of issuers. If you look at, we start with the public market, going over to the public exchange now, raising capital in a public exchange is very standardized, be it Nasdaq, New York Exchange, Hong Kong Exchange, or Singapore Exchange. Every public exchange will have a standard format and timeline that investors and issuers and advisors are very, very, very used to. But if we go to the private exchange, that is where it gets a little bit complicated, because you have two different sets of models as I see it. One is private exchange can be a platform whereby the exchange matches investors to issuers. Another format of private exchange we're seeing is a placement agent platform, whereby they would actually do the due diligence, they will do the preparation of documentation, the offering memorandum. And if we go to the investors, I think in the private exchange right now, it's more of driven by the high net worth, family offices, the pension funds, whereby these investors can take on a much longer term risk. So what that means is they can withstand 3-4 quarters of missing results, or even on an annual basis, they miss the first year results. But in the public markets, investors are a little bit more impatient. I think if you missed 2 quarters in a row, you will see a huge impact on your share price. So I think in terms of if you target the investors, then clearly if you're high growth, you might not have that much track record. You are raising capital based off management, based off a business plan, based off a product prototype. You have, maybe you have very little operating cash flow, very little earnings. Then perhaps the private exchange could be a better format of raising capital. If you go to the public exchange, the focus there is very much on track record. So we can see that in the past 12 months, the share price performance of the tech companies which have underperformed are those without much track record as compared to the ones with a strong execution, financial, and operational track record. So I believe that both exchanges are complementary. I think there is a different need for each issuer and also each investor type.
Rebecca?
Yeah, that's the approach that we take. So we take a very consultative approach when we talk to private companies, and we realize that it's not always the right time to go public. So what we do is try to give some education and statistics and put it into context, so the company and its advisors can make the right choice. So when you do embark on going public, it's a huge media exercise. You're signaling that you've arrived, but it's also the start of a new journey. So you're now a public company, and you need to, as I said, make sure that you're meeting all the requirements necessary in terms of disclosure, but also in the execution. And it really just depends on where the company is in its life cycle. In the private markets and also the VC world, you can be more in stealth mode. You still need to deliver but you're not kind of on the public stage where you need to really, you know, behave like a public company, be a public company, and be benchmarked to other companies in your segment. And another thing that we look for is real technology. So you might be a payments company from Singapore, but you might have competitors in Brazil, and you might have competitors in China and the UK, and 7 companies doing what you're doing in the US. So you also need to put your technology into perspective on a global basis, because investors in the US markets are going to be benchmarking you to peers all over the world. And again, you need to be doing something to innovate. So really, it's you can, you know, so take money from the private market and use that as your incubation and growing the public company in the private sphere. And then when you're ready, you can move to an exchange.
Kaidi, would you think that the private exchanges allow a lot more flexibility of structures and allow tailoring of you know, the funding structures to their specific requirements of the companies which are listed on those exchanges? Well, is that a reality or is that a myth?
Well, there's 2 layers on the legal structures. One is the company and the company shareholders agreement on the private exchanges. And these shareholders agreements can be very specific based on the companies. Whereas when you become a listed company, there's sort of a standard of being a listed company, of having investors in your cap table and the way this is structured. But when we talk about the private markets, and especially now when we talk about the Funderbeam case, then because of the regulation all around the world, and because the shareholders are treated and the direct shareholdership is treated in different countries, then the private exchanges very often operates in a way that the trading is consolidated behind the investment vehicles or use the investment vehicles. And this is the way, for example, Funderbeam is operating, is that we collect the funds from the investors, put it behind the investment vehicle. This investment vehicle is becoming the shareholder of the company, so that we keep the private company's cap table very clean and the trading is within the vehicle. But I can't say that there's going to be 172 different vehicles based on the needs of the companies. It doesn't work this way, because investors need to understand what is this vehicle they invest, what is this investment, what is this underlying company, and how does it protect investors' rights. So if the private exchange is operating in a way that there's going to be several different structures, like it is actually right now with so much in the ICO world, where the token in basically every case means a very different thing, then it's becoming very complicated.
Fair enough. Greg, I wanted to digress a little and talk a little bit about another type of private capital, which is absolutely huge competitor to both private markets and public markets. And we don't have a private equity guy in this panel, but maybe you want to talk about how you see private equity fitting into what we are discussing.
Well, and when you say private equity, I hear, or I think people mean different things. When you say private equity, I think of like KKR
KKRs and the CVCs and the Carlyles of this world.
Yeah, so I think...
and they're getting bigger and bigger.
Yeah, and they're raising more and more funds to go, really, what we used to call crossover funds, right, which is somewhere between venture and traditional private equity. And one of the things that I think is interesting, is a little bit picking up from what Kaidi said, is that there is a great deal more flexibility to structure private company financings, right? So and I'm just thinking of the Silicon Valley model, where you have different series of preferred stock, each of which can have very specific, very different terms and protections for investors. And so there's a great deal of flexibility, and what gets issued there are preferred stocks. obviously public markets primarily are trading common stocks. Now we have security tokens that are being issued. We have debt being raised in private equity. My sense and the way we are architecting the SharePost platform is with the assumption that much of these will merge, right? Is really the companies have always been on the same trajectory, right, in terms of their growth, and the different sorts of securities seem very different. Depending upon maybe the technology by which they are traded. So blockchain securities obviously very difficult or very different. Preferred stock different than common stock. Private equity, LP interest sold by Apollo. But there's 100 different startups each trying to create a liquid private market in all of these. And I think what gets missed is ultimately, at the end of the day, they're just securities used to represent an ownership interest in a company. And after all the hype and the speculation moves out of the market, and I'm thinking specifically of the ICO market, at the end of the day, what you're left with is the value of the money or the security that you own is going to depend on what the company goes and does with it. And so what we think the future is a marketplace where issuers can have common stock, preferred stock, LP interests, special purpose vehicle interests, digital securities, utility tokens, and the focus should be on the company and what it's doing much more than it should be on the type of security that it's offering.
Great. Okay. Matthew and Rebecca, we've discussed that private markets and public exchanges are probably complementary, and there is a time in the life cycle of a company at which point they need to be raising private money. And there's also a point where they need to be looking at public markets. But is it essential for a company to actually go through a private market before they're listed on the public exchanges? What would your views be? Rebecca, you want to start?
No, not essential, but many of the large IPOs that we've seen over the past couple of years definitely have leveraged both markets, and Facebook is a classic example. That's actually how Nasdaq private market sprung up, and you were proponents of that as well. So we merged two platforms together, and one of them was providing liquidity programs to Facebook. And we managed the liquidity program for Spotify before it went public. We're now doing it for Uber and Airbnb. And it actually helps the company to practice liquidity events and also using stock to incentivize employees and creating those controlled liquidity events, and get to know who their shareholders are, get to want to target shareholders, specific shareholders, not just I'm a public company and anyone can buy my stock. I mean, that's possible, but you can also have some influence over creating the shareholder base that works for you. So those things can be helpful as you prepare to then be a full public company. But it's not essential. I mean, we see plenty of private companies of all sizes go from being completely private to public. But what we do say is that you do need to start rehearsing being a public company. So for instance, closing your quarters on time, having the right corporate governance controls in place way before you even think about going public. So it's not too much of a shock when you are then on an exchange and meeting the requirements.
Matthew, do you agree with that?
Well, I think I'll look at it from a different perspective. If we look at the non-technology companies, clearly there is very, very little companies that actually went to a private exchange and then going over to the public exchange. I think the key reason there is they have access to bank funding. So in terms of a lot of the traditional companies, they would typically rely on bank capital, bank lending, the traditional instruments of financing. And then when they're ready and they have a 3 to 5 year track record, then they will go on to the public exchange. But I think for technology companies, if you're a startup, clearly it's going to be challenging to get commercial bank funding. And then you start with your Series A to B to C. That gives a sense, I believe, a platform or some finding in terms of valuation, given that a lot of the investors in the technology companies will look to exit. And every stage of your funding will clearly give a certain level of valuation, which is geared, most of them are geared towards a public exchange valuation. So I think the key reason why you asking the question is, does company need to go from private to public? That will probably only apply to the technology companies. As I mentioned, the access to bank funding as a startup is very challenging as compared to a traditional company.
It's almost impossible at the early stages for a variety of reasons, particularly in this market.
Yeah. I think in Asia especially, the banks here are still
asset-based, very heavily asset-based.
Very cash flow focused.
Correct. Yeah. Okay. Rebecca, there's one question which I wanted to ask you. You obviously work for Nasdaq and are based in Asia. Are there geographical differences which could impact the decision of whether to go through a private exchange or list straight away on public markets?
No. And certainly there are no barriers for any jurisdiction across the world to accessing US capital through US exchanges. We think, well, for us, it's about the technology. So the success of the company in the public markets is going to be about what the company is doing, and it's company specific. It's not really to do with where in the world they're located. Private market is quite US centric so far for us. So we might differ with you both, but we tend to serve primarily US companies at this point. So I think we are looking at how to bring in Asia unicorns into the platform. So that's something that we will work on.
Okay. Greg, would you have a different view of that question?
Well, so just some of the history is, Nasdaq Private Market was a joint venture between Nasdaq and SharePost. And so, certainly that connection point between the public markets and the private, that's a great example of it. And I think Rebecca is right. It is a sort of an on-ramp of sorts. That's the way it was sort of always designed, certainly from the Nasdaq perspective, into the public markets and practicing. In terms of whether the particular product there, the tender offer program, and just bias, I think that those, I don't expect actually to see those in a year or two or three, because I think as the private market becomes more liquid and more efficient, the need to do these, one large tender offer program to take care of a company's secondary liquidity needs for the course of an entire year is problematic. And I think if there might be alternative solutions that are more flexible, less sort of monolithic, one-size-fits-all, where individual shareholders can say, with company support and permission and control, I would like to sell some number of my shares, not all at once, all on the same terms, but as they need the capital. But that's also not quite here yet. So I think Nasdaq Private Market has played a really significant role in creating company-controlled liquidity along the way. If the question is more about sort of geography and how that impacts the private market, I think there's clearly a trend where much of this has started in the US. About 4 years ago, roughly 85% of all unicorns in the world were based in the US, and the great majority of those were in Silicon Valley. Now that number is just barely over half.
Correct.
And so, I don't think that means that the tender offer programs come to Asia, but I do think that the need for more liquid, more transparent, more efficient private capital markets certainly will. And it's some part of what drives it is the opportunity that brings entrepreneurs or encourages them to create companies to support that liquidity. And the more capital you have trapped in bigger and older private companies, the more incentive there is to create that marketplace. So naturally, that happened first in the U.S. where the trend started, so the platform started there. So they'll start here, or hopefully, some of the U.S. platforms will create global platforms, will globalize and create liquidity for non-U.S. issuers and U.S. issuers alike.
Okay, before I open it up to the floor, I have one final question. I'm going to request all of you to do some crystal ball gazing.
It doesn't have to be a tweet, though.
It doesn't have to be a tweet, no. But it has to be kept fairly short. And how do you think things are going to evolve? Will private exchanges succeed and stay independent, or will they be subsumed within the public exchanges? Rebecca?
They already have. So we bought Second Market, and we collaborated with SharePost. So we do see that is a way to serve entrepreneurs and founders, and we think it's an important part of the capital markets. And we have added blockchain capability to payments in the private market, so you can buy, sell, settle using Citibank's blockchain payments system. So we're seeing some innovation, or we were trying to introduce some innovation into the market as well. And clearly they serve a very important function, so I assume that they will continue to thrive. And I think you're right, I think they do need to spring up in a way that's appropriate for the Asian market as well.
Matthew?
I think similar to Nasdaq, we have 3 different platforms for fundraising. One is a private exchange, which we've invested into CapBridge. So that is for the high growth VC style investing, whereby we are also based off an exchange platform where we'll just introduce the issuers to investors, and we don't take a role as being a placement agent. So we are a pure exchange in terms of that market. The second platform is our Catalyst platform, which has a sponsor. That means you will have an underwriter or financial advisor firm sponsoring your company and to reach out to a different set of investors. This is more the middle growth segment companies. And then as you mature, we have the main board, which I think everyone is familiar with, where we have the larger cap companies and again, another set of investors. So we have 3 different platforms at different stages of your business. So I think being an exchange, we are cognizant and we're keeping an eye on the growth of the private exchange, as I believe currently is very fragmented. And if I take a crystal ball, we'll see a consolidation of the private exchanges across Asia.
Thanks, Matthew. Kaidi?
Yes, I do think so, because that it will be consolidated at some point. But I think because of the newest technology, because of the change of the investors, because of the millennials, tons of millennials jumping in the investment world, because of the ability through the blockchain actually provide the business across the world, which means you can get access to the volumes as the private exchange. I think now it's time for the first private exchanges actually stay independent.
Yeah. Greg?
Yeah, so clearly I think private markets will continue. And I think one of the things that we sort of haven't talked about that I think is sort of most telling in a way is that the average time to unicorn status, to crossing that $1 billion threshold, is 6 years for the current crop of unicorns. And so what that means is the unicorns, the majority of them today were found at a time where private markets were already quite robust and vibrant, and secondary liquidity for private companies was the new normal. And so a lot of the kind of older notions around when companies should go public, they just have never even had in their heads. And maybe it's a sort of the generation of entrepreneurs that are millennials. All right, this is the new mindset. And I think what gets overlooked a little bit is the way the culture of the capital market has changed. And here I can certainly only speak to Silicon Valley and maybe the US, but it used to be the case that entrepreneurs looked at going public as a destination in and of itself. To, I'll say, ring the bell of the New York Stock Exchange, but Nasdaq has an equivalent. It has a button, I think, right? It has a button. All right, at the Market Center in Times Square, that used to be the destination. And really the first time that I noticed a shift in that was with the Google founders, right, who were kind of dragged into the public markets by the regulations sort of against their will. And then you saw Facebook do the same thing, petitioning the SEC to try and delay their IPO. And I think that the longer the private market has greater capital, pays higher valuations, is more entrepreneur-centric and venture-centric, vision-centric. I wonder what drives an entrepreneur to seek the public markets in the future. Because if it's not cultural, it's not valuation, really it becomes about market efficiency and depth. But the more Kaidi and the other private markets that are being formed, that efficiency, particularly when you get into digital securities and how effective and efficient they can be in clearing, it really, again, to us suggests that there is a fundamental shift and potentially an irreversible one that has occurred.
Thank you very much. Let me now open it up to questions from the floor. And the one that I will take first is one which actually requires, I think, even a little more crystal ball gazing than you've just done. The question is, do you think ICOs will one day replace the traditional methods of raising capital, and why? Who wants to take a stab at answering that one?
Okay, I can take. I think no. Because there's still not a clearance what the ICO is. If it's a security issued using the blockchain, it definitely will challenge the exchanges. But what the ICOs already have done, it have been forcing the exchanges, both the private and public exchanges, to rethink the efficiency of the business models. It has introduced new layer of the where the value is created of the companies. Is it the protocol layer? Is it the sum of the service or the future service layer? So ICO will introduce a new way of investing, a new maybe asset class, if we can say it's a new alternative, and it will have its place in the future. But what I think is going to happen, we're going to in the future have like a piece of cake. Instead of equity, the piece of cake is going to consist of smaller layers, and that's what the ICO is going to bring.
The second question, I think, has already been addressed to a certain extent by Matthew. The question was, does Singapore need private exchanges? I think you've already addressed that to a certain extent. I don't know whether you want to spend a little more time on it.
Yeah, I think, as I mentioned, the purpose of the private exchange and our investment into Cambridge is more to cater to the early stage issuers. The types of investors we are catering to is also more for maybe perhaps the private banking clients, and more for the venture capital firms, the family offices, and the sovereign wealth funds. So what we have done is we are cognizant that there is clearly a rise in the private exchange, but more importantly, the amount of liquidity that is going to the private markets. So what we target to do is continue to be an exchange, to continue to match high-quality issuers and to high-quality investors. And I think it's in line with the initiative that the MAS Singapore has taken, that we continue to want to be a smart nation in terms of not just raising capital, but also in terms of the settlement and post-trade systems that we implement across our private exchange and the public exchange.
Greg, you want to?
Well, just to add to that, I think that's exactly right, in the sense that there is a need for liquidity for earlier stage companies. I think, although, or I'll say and this is not a disagreement, part of at least what we're seeing in the US is there's a need for private markets for much later stage companies, right? So the companies that we are dealing with obviously have billion-dollar valuations everywhere to $60 billion valuations. And so these are not pre-product companies. These are companies in some cases with more than $1 billion in revenue. And so I think that is in some ways more difficult to kind of reconcile with that public-private comparison, because these are companies that obviously in eras past could have gone private years ago, but have chosen not to, but still need liquidity. And the capital market is made better, and these companies are made stronger by having more efficient, more scalable, global access to capital.
Absolutely. And there are, and particularly if you look at continental Europe, there are a lot of these companies which are very large. You know, a client of mine has, as a family group, has revenues of about 40 billion euros, completely private. Capital raising is important, but decision-making includes exit strategy. Does this differ in the public versus private sphere?
So I'll take a shot at that. I guess I just maybe anecdotally speak about the development of SharePost and what we saw happening on our platform. So in the earliest days, The first trades on our platform in Facebook shares actually happened at 20 cents a share pre-split. That was a good time to be investing, and that was a good unicorn to have picked. But typically, in the earliest days, the market was serving very small shareholders, and there wasn't enough liquidity to serve anything larger or larger investors. And now, sort of fast forward, over the last 3 or 4 years, we've seen a significant number of institutions join the platform. And now, in 2017, roughly 40% of our volume was institutional to institutional trades in preferred stock, and this year it will be over 50%. So what you're seeing is an institutional market developing in which the block sizes are getting to the point where VCs are now seeing an exit in the private market. They don't need the companies to go public anymore. And what you're also seeing is sort of a non-VC type of investor. These are more hedge funds. And so think of like the Digital Sky Technologies and Tiger Globals are among the first of these. And they are much more financial investors, and they are looking for liquidity where they can get it. And by that I mean they are looking now to round trip their investments within the private market so that they can invest more in the companies that they believe in and reduce their exposure to those they're less confident in. And that's, again, as the market deepens, I think you're going to see more and more of that.
Thanks. I've literally run out of time, but I'm going to use the moderator's prerogative to take one more question, which I'm sure is close to Matthew's heart. It certainly is very close to mine. Do you think it's likely that we'll see more large public companies being taken private in the future? And how do you think this will affect Singapore's capital market ecosystem? I just couldn't resist taking this question.
I think in terms of delisting, it really boils down to the valuation. I think we have seen quite a lot of middle-sized real estate firms privatizing, clearly because if you look at the price to NAV, they're trading at a huge, steep discount. So we've seen that wave of middle-sized real estate firms delisting. We've seen a couple of healthcare firms which are delisting because they're not getting the true public valuation. But if the question is asked, why are they not getting the true public valuations, there is a certain element of investor relations or corporate relations that they are not doing a service to themselves. I think a true public valuation is when you are actively meeting with the long-only funds, the large institutional investors, and clearly telling your story, positioning your company, and laying out your 5 key investment highlights, and also providing clear forecasts in terms of your financials. Perhaps that is lacking in some of the firms that we have seen that have gone delisted, given that they are not enjoying a true public markets valuation. Do I see this as an issue going forward? I don't think so. I think the exchange, we continue to see a very strong pipeline of companies across sectors from REITs to real estate to consumer to healthcare to commodities. I think there is still a very strong reason for issuers to want to list a company, not just in terms of branding, in terms of profile, but being listed gives you access to different forms of capital, from the bond market to the perpetual bond market to the mezzanine equity market and to the equity market itself, and also giving you a deeper access to bank syndicate lending as well. So I think there's still a very strong push for many issuers across Asia to list their company on the Singapore Exchange.
Thank you very much, Matthew. Thank you very much, ladies and gentlemen. I hope you've enjoyed this panel discussion. We could have actually continued till the cows come home. I'm sure there are enough points we would want to talk about. But once again, thank you very much for your presence and attention. And please join me in thanking the panelists as well.